Hello, happy spring. Hope you're doing well. Hope you've gotten a chance to spend some good time with family and friends. Today, I just wanted to do a review of first quarter and talk a little bit about the kind of long term. Okay, so first quarter, I don't think I have to tell any of you, was a rough quarter. We had the war in Ukraine, which is horrible from a human standpoint and economic impacts, inflation, supply chain woes, and the energy crunch, which I'm sure you've seen at the gas station. So I thought we'd look at the positives first. The underlying fundamentals are still extremely strong. We have a strong economy. It was growing at 5.8 in 2022. Consumers in a very strong position. Demand's high for travel and restaurants. Employment remains strong, unemployment at historic lows, and corporate earnings remain strong. They're expected to grow at 10% this year. The headwinds, the war in Ukraine and the impact there, inflation currently over 8% at a 40-year high, and rising rates. The Federal Reserve trying to combat inflation and increasing the interest rates. First quarter, you can see on this chart, US stocks were down 4.6. They were somewhat the bright spot, but for the 1 year, the market was still up over 15%. I think the surprise for the quarter was how quickly the bonds priced in inflation. The bond index intermediate was down right around 6%, with short-term down about 2.5% and long-term actually down 11%. Just a note on the bonds. So if you remember, we were repositioning the last year or so to be in short to intermediate term bonds. So right now, the bonds have already priced in 2.5% of rate increases, and which is what we expect for this year. And we've only seen so far 0.25%. They're also resetting at higher yields, which means you're getting more income, and we expect better performance or more stability the rest of the year. Bonds remain a key component of a diversified portfolio. They provide liquidity, stability. A down market for the year in bonds might be 10 or 11%. A down market for stocks could be as high as 50%. And also they protect against inflation. If you're in a money market account and inflation's at 8%, you're losing close to 8% purchasing power every year. The next thing, I saw an interesting article that I'll send to you from Russell, that it pays to own stocks for the long term. If you see right here, the majority of returns are in the positive, over 10% annual for stocks. Stocks have been up 74% of the time over the past 95 years on an annual basis. This chart is interesting. I won't go into a lot of detail. I will send it to you, but it basically shows that even if you invested $12,000 a year for 10 years at the high of the market every year, you still would have made twice as much money as if you would have held it in cash. So interesting chart that just shows it pays to be invested for the long term in stocks. Our overall strategy: appropriate asset allocation, plan for withdrawals. If you're taking withdrawals, we stay committed to choosing quality, sound investments and just partnering with you to stay the course. Review for the quarter: asset allocations, the bond side, the equity. We're focused a little bit more on the value side with this cycle of the market. And then tax planning is tax loss harvesting where it makes sense, and possible Roth conversions at lower values. So I look forward to seeing you. You can schedule online or call me in the office or remote. Have a great day. Thank you.